Hi, good afternoon, everyone. This is Peter Walls from Kinlock Capital. Thanks for joining us on our monthly update. This is the update beginning of June, largely going to be talking about what we saw in the month of May. Take a look at our indicators and what they're suggesting to us. We're going to take a look at changes in allocation based upon those indicators. Going to make sure that you understand what your account should look like right now, and then finish up with some monthly talking points. I've been trying over the last couple of months to pull a cartoon from the New Yorker, and I think this one is appropriate for this month. Obviously, we've got a couple of gentlemen here, the coming boom versus the coming collapse, and I think this is very common in the market, and the talking heads that get trotted out on TV is that you can have two very experienced individuals, you can have two very intelligent, well-schooled, well-trained, working for top firms and companies, and they can have dramatically different opinions upon what seemingly should be the same thing, either the direction of the market or the direction of interest rates or unemployment or anything else. And so this was certainly something that confounded me early in my career, which is when you have two seemingly equally intelligent and well-trained folks telling you to do exactly the opposite thing, how do you know who to trust, or how do you know what to do or where to hang your hat with so much conflicting information? And it's from this idea, from this cartoon here, that 20-some years ago I embarked, or as I was embarking on my money management career, to decide not so much to listen to what people said, but to begin to watch what the market was actually doing, and to take our cues from what the market was doing, as opposed to what people were saying that the market should or should not do. And I can tell you that I think that was a wise decision, and I think we have made a lot of money during good times and prevented a lot of pain for our clients during the bad times by using this idea of don't listen to what we say, but let's watch what the market is doing. And that's really what technical analysis in my area of expertise is all about. Let's take a look at what the market's doing. It has a way of cutting through all the noise. And let's take our cue and based upon what's actually going on, as opposed to maybe what should be going on or ought to be going on or we thought might go on. So jumping off, as we always do with these calls, taking a look at the long-term chart of the S&P 500. For those of you newer on these update calls, this is typically where we start. This is a 20-some year, more than 20-year chart of the S&P. The market peaking in 1999, the tech wreck here, the market peaking in 2007, and the financial crisis in 2008. And for by and large, since 2009, more or less a fairly healthy up and to the right kind of market action. That was certainly interrupted several months ago with some big drawdowns, and I'm going to zoom in here and we're going to take a look at what's been going on more recently and how we've responded to it. So I'm going to take this part of the chart here on the right-hand side and blow that up so it's a little bit easier for us to see and understand. Okay, so let me see. So what we've done here is taking a look at the market, and this goes back more like 36 months or so. What I want you to focus on, if you can, with your eyes, I want to see if you can kind of ignore the what we call candles, green candles, red candles. This is a monthly chart, so each of these figures represents a month of time. If you see a green one and it's open, that means the market finished up that month. If it's red and filled in, that means the market is down that month. But even to separate out these individual blocks, let's just take a look at this orange line here. This is a 10-month moving average of the S&P 500. It equates most closely to the 200-day moving average, and it is probably the most widely used instrument to judge whether the long-term direction of the market, in this case meaning the S&P 500, is up or down, or in some cases maybe trading a bit sideways or trading flat. So cover up this in your mind a little bit, and let's just follow this orange line. And I think we can see that for the most part, over the past 36 months or so, certainly a very nice, smooth upward motion for most of this time. A little flattening here, even a little decline here. And then we get back to this kind of nice, gentle upward motion. And of course, I said that was interrupted a couple of months ago. This is the month of February. This is the month of March. We see the action here, and we also see the long-term trend line coming down. And then most recently, over the last 60 days, we see this bottoming of the trend line, and it appears that we are moving back up here, and the slope becomes higher, okay? So we can kind of get a good general idea of what the market's been doing just by kind of looking at whether this is trend line is sloping up as it is here, kind of moving sideways as it is here, or sloping down as it is there, sloping down as it is there, okay? So we can get a general idea of it, okay? But where the rubber meets the road and how we're going to make decisions is we're going to make decisions in terms of our asset allocation based upon whether this trend line is trending up or down, and also by this lower indicator, which we refer to as momentum. This is trend in the upper 2/3 of your screen. This is momentum in this bottom piece here. Trend and momentum, long-term trend, long-term momentum. Those are the two key indicators that we use to gauge whether it's safe to go in the water, if you will, okay? So I have, what I want to see from a trend perspective is I want to verify that the market, after having been in a downtrend for several months at the beginning of the year, is indeed back in an uptrend or not. And the way that I do that, or the way that we do that here at Kinloch Capital, is to see where the market closed at the end of the month versus where is the trend line. And are we currently trading above the trend line, or are we currently trading below the trend line? Again, the trend line itself is this orange line, all right? And I've actually, I can do it one of two ways. Either I can visually inspect this, and I can see that, you can see I've highlighted this candle here right at the end. This is ending May. This is a few days ago. And I can see that the market finished here, looks like right about 30.50, the S&P. And I can tell, just by visual inspection, that this is above the long-term trend or the long-term average. Think about whether you want to be above average, whether you want your kids or your grandkids to be above average. In a very similar manner, we're looking to invest when the trend is trading above average. We want it to be above average. We think that that means there's an above average chance of an expanding or a growing market. I can also look just at the numbers themselves, and I see that at the end of May had an open, a high, a low, and a close. And the close is what I'm interested in. These other figures, where the market opened May how high it went for the month, how low it went for the month. That's all interesting to me, maybe provide some talking points. But my key decision comes from this right here. May close, on the last trading day of May, where did the market close at? And I said, it looked like it was right about 30.50. In fact, that exact number here, 30.44. And where is that number in relation to the average? This figure that says MA stands for moving average. Well, the average is 29.57. So literally what this means is that over the last 10 months, if I added up the market close for the last preceding 10 months, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and divided it by 10, the average closing price over the last 10 months has been 29.57. But my close in May, most recently, was 30.44. So I am currently trading, as at least of May 31st, the market was higher than the long-term average, okay? So I'm going to use that as a claim that the market is back in a long-term uptrend. After 2 or 3 very scary months, we had a very sharp decline and we had a very sharp recovery. But at this point, the market is back into a long-term uptrend. The other key factor that we want to look at is momentum. This is market momentum, market inertia, oomph. For those that have been on call, know that I often refer to this as the market airspeed. Here's the market direction. Are we up, down, or sideways? So here we are up, here we are sideways, here and here we were down. So trend speaks to direction. Momentum, though, as the word probably alludes to, speed, velocity, rate of change, inertia, okay? And again, I often think of it as airspeed, and know that when you're in an aircraft, requires a certain amount of speed going across that wing to create lift. And if there's not a certain amount of speed, then the plane will stall. But as long as there's air moving over that wing at a certain speed, that plane will fly. I don't care how heavy that thing is. And we want to see positive momentum. That's a reading of above 100. This reading here for the end of May, 105.65, literally. So I do have, first I'll say I do have positive momentum. That's a number that's above 100. I like numbers when it's above 100. We are fearful of the market when we get these dips below 100, which we were a couple of months ago. But again, the market has recovered somewhat in terms of trend, and the market has recovered somewhat here in terms of momentum. And so right now, that leaves us with both of our major long-term indicators being positive, and gives me confidence that we can continue to push money back into the market after having been conservatively allocated several months prior, okay? So that is in fact what we did a number of days ago after this data was released on the, well, I think this says the 31st. The last trading day was a week ago, Friday the 29th, when I came in, and Monday and verified this. We made these changes, which is 2 of our 3 tactical models. These are the models that can and will change their asset allocation, their mix of stocks and bonds, depending on our reading of these long-term indicators, okay, have now moved back to what we consider to be a growth allocation, or another word is a more aggressive allocation. And basically we are around 80-20, meaning about 80% stocks and about 20% bonds, okay? So we're not in a conservative allocation, we're not even in a moderate allocation, okay? But we moved a number of days ago based upon this recent trend change that we saw in the month of May. You can see in March we had a very nice upward movement, but the market finished here and the trend line was here. So we finished below trend. That was rectified in, this is April, this is now May. In May, we moved higher and closed above the trend line. So that change in trend has caused us to move from a moderate 50-50 allocation where we were last month to a more growth-oriented 80-20 allocation where we are this month. Okay, so that's what's going on allocation-wise with sector rotation, tactical balance. We have a third tactical model, which moves to the beat of a little bit different drummer. And in fact, we have not seen any changes to that model in this month. That model has remained unchanged. Last month it was 2080, and this month it continues to be 2080. I can see if I can, pardon me, I was going to see if I can blow the screen up a little bit. Pardon me. So let's take a look for just a minute at the end of April then. Basically what we've got, this is our model that we refer to as American Momentum, because the only thing that is in that model are mutual funds from the American Funds fund family. American Funds is one of the top 3 largest fund families in the country. And as I've often said, I'm not saying that they're good because they're big, but over time, money does have a way of finding good returns. And this company has become very, very large, quite frankly, because their funds tend to do pretty darn well over time. The reputation of the American Funds fund family in the financial advisory world is that you rarely have to apologize to your clients when you own American Funds. Well, that may be the case, but what the American Funds fund family, which has something like 25 or 26 different funds, they're listed here, they are the ones that are picking the stocks inside the stock funds. They are the ones picking the bonds in the bond funds. But what American Funds will not do is call you up out of the blue and say, you know, Mr. Jones, you know, Mrs. Smith, I think given the market environment, you ought to change your allocations. We want you to be with our fund family, but we think you ought to own these American funds right now as opposed to those American funds. You will not get that call from American Funds. That, in fact, is what we're doing. So this is, I know looks like sometimes we call it the quilt, but it essentially what this shows is a stack ranking by some trend and momentum indicators, a different set than the ones we looked at a few minutes ago, but the same basic idea. And what these trend and momentum indicators do, it's not for the S&P 500, but for these particular set of funds, is stack rank them based upon short-term, intermediate-term, and long-term performance. The best performing ones rise to the top, the laggards kind of bring up the rear. And we inspect this chart once every 30 days to see if there are any changes that need to be made. Changes meaning, do we want to own some of these funds as opposed to the other? What we want to do at any one point in time is essentially own the top quintile, the top roughly the top 5 out of roughly 25 funds. So last month when we did the reading here, you see this is as of the end of April, okay? The top 5 funds here, high income muni bond, government securities bond, bond fund of America, tax exempt bond, and then we've got this fund, growth fund of America. That is a stock fund. So when I say we were 80-20, what I mean is 20% of our money, we're going to own 5 funds. 20% of our money went into growth fund of America. The others went into these 4 bond funds. If I come back here roughly 30 days later, not at the end of April, but here at the end of May, once again, I'm going to look and see what are my top 5 funds. Government securities, bond fund, tax exempt. Now this one, growth fund, moved into the 4th position, high income muni in 5th. So these two actually switched places, picked up, so the model picked up on the fact that stocks increasingly were doing well, and this growth fund outpaced this muni fund. But no change overall. The top 5 funds from last month were the top 5 funds of this month, although it looks like hot on the heels here, number 6, new economy. So we'll see. We're going to keep our eye on this, and it very well may be new economy rolling into the portfolio next month. But for this month anyway, our allocation has remained unchanged in American Momentum. Okay? So what should my accounts look like now, or what do my accounts look like now? Last month, we reviewed how to know what was in each of your accounts, and also how to nickname those accounts so that you could easily maybe compare on the screen if you're watching this, or you watch this and then want to go look at your accounts. Okay, there is no such thing as a blended account, meaning each account number that you have contains one of these models and one of these models only. We just do not run blended accounts where you'll have you'll be running, for example, in your account 1, 2, 3, 4, 5, 6. We've put half of that account in balance and half in American Momentum. Or in your account 5, 6, 7, 8, 9, 10, 11, 1/3 of your money is in sector rotation and the other 2/3 is in American Momentum. It is one account number per model portfolio. So if you were to open one of your accounts, if you happen to own the Tactical Balance model and you open and look at your positions, this is what you should see now, okay, which is basically S&P 500 at about 80% of your value, short-term bonds and cash as roughly 80%. Okay, so here's an S&P 500 index fund that's got about 40% of the account value. Here is another S&P 500 index fund with about 40% of value. Here is, we said we were about 80-20 stock bonds. Okay, here is our bond fund position. I know this doesn't say BND or BOND. This stands for short maturity. It's basically the safest type of bond fund you can own, with roughly 20% of the money. There is a little bit of cash in this account from accumulated dividends, and to allow for those clients who take distributions every month from their portfolio. But I think you get the idea that this is a roughly 80-20 split, okay? If you have sector rotation and you open up your account, what should I expect to see? Well, this is what you should expect to see. Again, here I've got my short-term bond fund at roughly 20% of the account. There's a little bit of money, again, left in money market from accumulated dividends and such. And then what we see is individual sectors that we own. Tactical Balanced really is our most straightforward model, and is often the model that requires the fewest changes or alterations. It essentially is S&P 500 index funds on a dimmer switch, right? Which means we're going to be, by and large, in the S&P 500, okay? But that allocation will change from growth to moderate to conservative and back and forth as market conditions change. What do I mean by market conditions changing? I mean, what is the current trend and what is the current momentum? When those things are all systems go, we have a growth allocation. When both trend and momentum are positive, we're going to have a growth allocation. When our signals are, long-term signals are mixed, meaning in this case, I have to go back and count the months to see what months this was, but we had a positive momentum reading. I know that because here's my 0 line and here's my momentum. However, the market finished below trend. Here's where the market finished. Here's where the trend line is. we're below average. So that's a situation where trend and momentum are sending mixed signals. This is sending a negative signal in relation to trend. This is sending a positive signal in terms of momentum. So when our long-term signals are mixed, we're going to hedge our bets and choose a moderate 50-50 allocation. And then in times like we were in a few months ago, when here's our trend line, here's where we were trading, well below trend. And in addition, momentum is negative. That's a time when we really want to pull in our horns. Fortunately, the market has snapped back relatively quickly. I remind you that what did happen did not have to happen that way. And if things had gone from bad to worse, we would have been very well prepared for that, very well hedged against that situation. But I do have to respond, not to what people are saying, but to what the market is doing. And what the market is doing is enjoying a very strong snapback. And so even though we became conservative just a couple of months ago, we are already back into growth mode based upon what is happening in the market. We are following the trends of the market. Okay, so tactical balanced, again, very simple. We're S&P 500, aggressive, moderate, conservative based upon market conditions. Sector rotation just takes that idea and moves it one step further, which is, okay, Peter, if you're telling me that you think it's okay for 80% of my money to be in the market, maybe we should drill down even further and say, what do we think the best portions of the market are? Which sectors of the market? There are 11 separate market sectors that make up the S&P 500. Right now, we are in 4 of them. These are the 4 that are performing the best right now. Information technology, or quote, technology stocks, healthcare stocks, my guess is you can all guess why, communication stocks, and also consumer discretionary. That means people continue to shop even though the economic figures have not been great. Spending figures never doubt Americans' ability to spend their money. And so these are our sectors. So if I add up these 4 pieces here, I think you will get a number very close to 80%. That's the same equity representation that we're getting from this equity representation here. And finally, American Momentum. We know that our allocation is different. Here's our 20% allocation to Growth Fund of America, and here's the remaining allocation to fixed income funds. Again, I'm not overly concerned about the fact that these seem to be acting more quickly or faster or responding better to the recent snapback of the market. We rolled out American Momentum as a model in 2008. And over the next 10 years, it was our #1 performing model over that 10-year period. So the fact that it may not seem to be jumping on the bandwagon as quickly as these 2, again, over the long term, I'm really not overly concerned because this model as well has a great long-term history. So we're going to finish up with some talking points for the month, and that is, I think that Mr. Market, or the stock market, continues to move higher despite economic numbers which continue to be poor on a daily basis. The growth rate of the economy, meaning GDP, or the unemployment figures, again, are much higher than they were. Growth in the market is growth, I should say, not in the market. Growth in the economy is slower. Unemployment much higher. This certainly does not seem to be a great economic conditions. However, the market is shrugging that off, and there is a big disconnect right now between how the economy is doing and how the market is doing, or at least what is being reported, okay, about the market. And I think that that's really the key to understanding, or among the keys to understanding what's going on, is remember, the market is a discounting mechanism. More simply said, the market is constantly looking ahead, okay? The market is not so much concerned about what's going on now, but what's going on, what do we expect to go on 6 months from now, 9 months from now, 12 months from now, okay? Historically, the market bottoms about 5 months before the economy recovers. So if we did in fact see a bottom several months ago, let's see, this is May, this is April, this is March. If this is the market bottom in March, in fact a little bit lower here in April, okay, it very well may be late summer or early fall before the economic figures that are being reported actually start to get better. But the way the market thinks about it is, hey, if things are going to be better 6 months from now, we don't want to wait 6 months to start buying stocks. We want to buy them while they're on sale now and enjoy the ride up. I used to have a coworker who would joke with his clients and say, Mrs. Jones, do you want to watch it go up and then buy it? Or do you want to buy it, then watch it go up? And the market, while a lot of investors do the latter, the wise thing is to do the former. Don't watch it go up, then buy it. Let's buy it and watch it go up. And so we have to be willing to buy even when the economic news that's being reported seems poor. In fact, the reason why investing based upon the headlines tends to be not a great long-term investment strategy is, again, the market is looking forward, the media is reporting data that has happened in the past. So you're never really able to get ahead of the market if you're investing upon data that's already dated by the time it makes its way to the headlines. So in closing here, my final thought, we still could see some volatility between now and over the next 3, 4, 5, 6 months. Summer doldrums, we'll see if we can get these beaches back open. The market tends to be very ho-hum during the summer months, and sometimes it's not just people selling that makes the market go down. Sometimes it's just hedge fund managers at the beach not buying, and that lack of buying provides market supply. And so we are going into a period of time when historically the market is lackluster during the summer months. However, colliding with that is this whole idea of the economy being reopened after this probably 90+ day shutdown. So once again, we're kind of stuck with these two fellas here. Is this are we positioning here for the reopening, or are we staying conservative based upon economic numbers or the historical humdrum days of the summer? Which of these is right? And obviously we will only know for sure in hindsight which is right, but we've got to pick a side, we've got to pick a direction. So the direction that we have picked right now is based not upon these headlines or whatever, but is based purely upon what the market is actually doing. And right now, the long-term trend and long-term momentum are both positive. Here's our trend. We're trading above trend, and our trading with positive momentum, a number above 100. So for better, for worse, we're going with what's actually going on. And so we're positioned for higher prices in the future, and going to try to capitalize on those. So thank you all very much for your time in listening to this. I hope that makes you feel smarter about your investments and how we're handling your money. As I say during every one of these calls, if you have a question about what we've gone over or how it affects you individually, by all means, give me a call, shoot me an email, ask me to give you a call. Happy to chat for as long as it takes to make sure that you understand what's going on and why we're doing what we're doing. Thank you all very much, and we will talk next month, if not before. Bye-bye.